The other big elephant in the room that came out since the last meeting was the idea of unwinding the balance sheet. And you know, this is something that markets didn't really know how to react. They actually didn't do a whole lot of anything. The announcement came in the middle of you know, some of the things that were happening in Syria, so it was largely overlooked. But you know, quantitative easing, we had 3 rounds. They bought about $4.5 trillion worth of U.S. government bonds and agency-backed securities. So this is government debt. The Fed decided once they lowered interest rates to 0, they didn't want to lower them anymore. So they started doing things that would affect long-term rates. By buying U.S. government debt in tenors from 5 to 30 years, they're able to push long-term rates lower in addition to already moving short-term rates lower. So, you know, they did this 3 times. You know, historians will probably argue for the next 100 years of how effective that was or wasn't. But one of the things that we know is that in order for it to have been deemed a successful endeavor, we're really going to have to renormalize, and part of that means unwinding that $4.5 trillion. So one way to look at this is if the Fed comes in and starts unwinding these securities that they essentially bought with money created out of thin air, this is the same as if a hedge fund came in and started selling massive amounts of long-term debt. Clearly, that's going to drive rates higher. Now, we don't think that the Fed is going to come in and, you know, bang this out all at once. We think that they'll take a very measured approach, but it kind of puts a little bit of support on yields, and it's probably going to take them 5 to 10 years to do it, if I had to guess. But that constant selling of these long-term securities into the market, this is something that is going to have a very big impact on the market, even if it's spread out over many years. And again, why do they want to do this? Why did Yellen come out and announce that they're planning to unwind the balance sheet? They don't make these announcements without careful consideration of the impact. And I think, again, it points to the fact that they want to raise short-term rates. There's a lot of benefits to the Fed by renormalizing short-term rates, probably first and foremost among them that when you raise short-term rates back into that normal range, you now have the ability to respond to a crisis by lowering short-term rates. This is what the Fed has done for many, many years, and this is how they are able to respond. What they're seeing now is that raising short-term rates without allowing long-term rates to raise is causing potential problems. And this is something that could have a very negative impact on the banking sector. If you think about your local bank that borrows from depositors at short-term rates and then lends money out at long-term rates, that's how lenders operate. They need long-term rates to be higher so that they can earn that carry. So if we start seeing that spread that we see shrinking between short-term and long-term rates, at a certain point, that's disastrous for banks and lending institutions. And I think that given the last crisis that we had with banks, I think the Fed really, and wisely so, wants to avoid any kind of a crisis in the banking sector. And one of the ways that they need to do that is to push long-term rates higher so that they then have the room to continue raising short-term rates. And I think that they were very strategic about announcing that, hey, we're thinking about a plan to start unwinding the balance sheet. In 3 weeks, we're going to get the meeting minutes from yesterday's meeting. And I think that even though they did not mention the unwind in the comments yesterday, I think that we will read into what the Fed is thinking a little bit more when those minutes come out in 3 weeks.